The zero interest rate policy, ZIRP, adopted by central banks worldwide, led by the US Federal Reserve, pushed investors to seek higher returns, resulting in global rallies in stock markets, real estate, crypto tokens, digital art, and luxury goods. Venture capitalists were driven to invest in startups with uncertain business models, hoping to sell off the companies to new investors. However, with high inflation in the rich world forcing central banks to raise interest rates, money became more expensive, causing cash burn business models of highly valued startups to unravel. But in 2022, unlisted startup valuations did not immediately respond to central banks raising interest rates. A year later, the valuations have started to fall. Let us discover how changing interest rates impact startup valuations and the role of India's digital consumption in this revealing video. A recent news report in Mint pointed out that startup valuations in the private market are beginning to crack. Another news report by Reuters pointed out that, in recent weeks, BlackRock internally halved the valuation of Indian online education firm Byju's. It has invested into $11.15 billion from $22 billion, while Invesco slashed food delivery firm Swiggy's valuation by a quarter to $8 billion. The interesting thing is that the digital consumption story which was built up is also unraveling in the process. At its heart, like most saleable stories, this was also a simplistic one. India has a huge population, close to 1,430 million now, and so there will always be a huge market for whatever startups want to sell, especially as digital payment mechanisms like the Unified Payments Interface, UPI, become more popular. And given this huge potential, huge valuations are justified. The trouble is that a large population and the ability of that population to buy things, or there being a viable market for what any startup is trying to sell, are two very different things. One of the most important points in the story of startups has been the success of UPI. But just because UPI transactions are growing, it doesn't automatically imply that the overall number of economic transactions are also growing at the same pace. Also, when it comes to consumer transactions on which valuations of startups are built, a few people seem to be making a bulk of these. As the Indus Valley Report 2023 published recently pointed out, 1% of Indians take 45% of flights, 2.6% of Indians invest in mutual funds, 6.5% of users are responsible for 44% of UPI transactions, and 5% of users account for a third of the orders placed on Zomato. Of course, the valuations of startups were based not just on small super user sets, but the supposed consuming ability of India's huge population of 1.4 billion plus. But as the super user data points show, a large population and people's ability to pay for stuff are very different things. And that reality has begun going into the valuations of startups.